Everybody, this is Rob Keynes with the Freedom Report. This is your weekly market wrap-up for July 2nd, 2024. As you guys may have noticed, I was out last week. We were out on vacation. Went on a good trip with the kids. So we've got a lot to catch up on this week. So we're going to dive right into it, and we're going to do our normal report. I'm going to talk about what's going on in the markets. We're going to talk about the major economic data and news of the week, and then we're going to go into gold. And stay tuned to the end because I'm going to go over the World Gold Council's mid-year outlook. If you guys don't subscribe to that, and a couple of the charts and data points in there, which I think are interesting and may give a good preview as to where gold and silver, the direction that they could go coming into the fall. And I'm going to relate that to the economic data at the front of the report. So listen all the way through to get that information. So as far as the markets goes, the Dow Jones trading at 39,309 at time of this report, about 3 p.m. Central Time. S&P at 5501, NASDAQ 17,998, Russell 2000 at 2036.13. All of those indexes are up less than 1%, somewhere between 0.3 and 0.6%, so doing okay. Moving over to the bonds, not a whole lot has happened there. We're still in yield curve inversion in terms of where the rates are relative to the benchmark 10-year, meaning everything shorter than the 10-year basically is trading at a higher interest rate. Well, actually, if we look at the 10-year at 4.431, you have to go to the 3-year. So the 3, the 2, the 1, the 6-month, 4-month, 3, 2, and 1 month are all trading higher. The 2-month is at 5.378, which is the high. The 3-month comes right behind at 5.375%. The 2-year, which is the big one when you look at yield curve inversion and recessionary risk, is trading at 4.737, whereas the 10-year is at 4.431. The yields between the 10-year and the 2-year that you look for a yield curve inversion as a recession indicator have compressed somewhat lately. And I think that's mainly because the summer tends to be a little bit slower time, as I mentioned to you guys. That's why when we do these, we do a little bit less overall financial-based content during the summer because a lot less happens. The markets tend to die down just a bit. Now, that doesn't mean they have to stay that way. If something big happens geopolitically, or with the banking system, you'll see a return to the news cycle and you'll see a return to changing financial landscape, including gold and silver. But I'm expecting things to calm down during the summer. I expect gold and silver price to fade a little bit as we get toward the end of summer. And we're going to talk about that today and show you what's going on there. The cryptocurrency complex is down a little bit. It's not, over the last few weeks heading into the summer, Bitcoin's at 61,872 as I'm reporting this. Ethereum is at 2318, Ethereum Classic. Litecoin's at 75.34, XRP trading at 48 cents. Not a big change there. Overall, the markets are pretty stable and going into their sort of somewhat hibernation phase in the summer. We did get some good print on economic data. Last time I did this report, I did tell you about the data that came out on the home price index. It was 7.2% raise in home prices last month. That's significantly higher than the CPI. It's lower than the 7.4% the previous month, but it's still high. It's about double what you see the CPI. And I think it's a better indicator of the actual inflation rate. I don't really believe the CPI, but housing is elevated and those prices are going to have to come down. Consumer confidence has fallen a bit from a 101.3 to 100.4, still above 100, so it's considered positive, but it's fading a bit as we head into the summer. I did report this last time that new home sales were down from 698,000 to 619,000, and jobless claims went down a little bit. The initial jobless claims from 239,000 to 233. And overall CPI or PCE rates for inflation were about the same as they were the previous month. So we're not seeing a whole lot increase in the official government inflation, although I think we're seeing it continual persistent inflation higher than what the government's reporting at the grocery store and on the electric bill and things like that. The S&P final U.S. manufacturing PMI index was just an indication of manufacturing expectations of manufacturing entities across the sector. Fell just a bit from 51.7 to 51.6. It's still slightly positive, but it's falling a bit. And manufacturing basically has been falling for the last couple of years consistently, especially the last year. So weakness overall in manufacturing, just sort of hovering at the same spot again because of the summer. Construction spending is down, going negative 0.1%. And the ISM manufacturing index fell slightly, 48.7 to 48.5, again on manufacturing. U.S. job openings unexpectedly have risen from 7.9 million to 8.1 million. I'm going to read an article from 𝙍𝙍𝙀𝙎 on that. After 2 months of sharp declines in the number of job openings, a moment ago, Biden's highly politicized Department of Labor reported that in May, a number of job openings unexpectedly spiked by a whopping 221K. Most of this is government jobs, as reported by 𝙍𝙍𝙀𝙎. That was a quote from 𝙍𝙍𝙀. And it's not private sector jobs, it's government. Job openings, the government has been spiking, dating back to the year 2020. And it turned down slightly in 2023, but now it's on the rise again, almost to its peak of where it was in 2022. So the government is the big hirer, and the private payrolls have decreased. May of 2023, there were 8,240,000 private job openings, hires and separations, total private, and now there's 755. So overall, the amount of job activity in the private sector is going down, government's going up, and that's the main thing that you need to know about that. I'm going to share a screen, and we're going to talk about a couple of economic factors which are better presented in graphical format. So here is U.S. energy production, which exceeded consumption by a record amount in 2023. So it used to be that people felt as though we were going to run out of energy because of demand, but demand's fallen 17% year over year, and production now exceeds demand here in the United States. And so the U.S. is going to be positive going forward from an energy perspective. Expect certain types of energy price to go down, although oil has gone up. That's because the U.S., while it's one of the top oil producers, is not the only one, and costs are rising overseas, but overall energy costs are coming down, which is a good thing, but it's a signal of deflation because demand's gone down 17%. So if you look at jobs numbers and look at how they're mostly part-time versus full-time, and you look at energy consumption, it's clear that the economy has rolled over. You can also see that in other data points with relation to real estate, the bond market, things like that. So we're sitting in this rollover period where it's going to roll over for a while, or it's going to plateau and kind of come down for a while before you have that big cascade fall. We're not at the cascade fall yet. I don't expect that to happen this summer. But remember, earlier this year, we did have someone come on who did Elliott wave analysis predicting that the stock market would turn over this summer. I haven't seen it. And a lot of times those Elliott wave analysis are not 100% correct in terms of timing, though usually in direction they are. So we'll wait for that stock market rollover. We haven't seen it yet, but I suspect that that's not going to happen until you see rollovers in the bond market, the real estate market, and those other things first, and stocks usually come last. But we'll continue to follow that. I wanted to give a really nice chart at Visual Capitalist talking about U.S. wealth by generation. I've shown a similar chart before, which is more of a pie chart, and it showed that baby boomers had half of all wealth. This is more of a line chart, which shows the same thing. You can see in a red, baby boomers have $76.2 trillion in worth. That's 52% of wealth in 2023. Gen X is, my generation, is 37.8, about half of that. The silent generation, which is the wartime generation, most of them have passed away, still have 19.7. Again, they're holding on to land and things like that until they pass away to will them down. It's ostensibly probably going to go to baby boomers, Gen X, or charities and that type of thing. But you look at the millennials and they have the least. And the millennials are in their prime earning years, and you would expect that this would turn up. But the turn up in millennial wealth is more expected to come from the willing of property down from baby boomers and Gen Xers, and even the silent generation into the younger generations, not because millennials are getting jobs or because their asset classes are going up, because they're not. And this is tied to the dollar cycle. It's very easy to say because the dollar had most of its purchasing power boom during the baby boomer and silent generation, they have most of the wealth. And as the dollar is weak, and the Gen Xers, the millennials, and now the Gen Zers don't have the purchasing power, the ability to keep up with inflation and actually build wealth through assets. So they're not seeing the wealth creation. Again, just another chart that I wanted to show the same thing we've talked about in the past. All right, that's the economic report. I'll give you a summary of that at the very end, but let's get into gold and silver. As we always do, we're looking at gold right off of the CME Group's website. Lower volume as you would expect in summer. That means we'll probably have a drift in price because lower volume, lower interest, and you can see indeed that we've had a reduction in overall interest, which I'll show you in the COT report here in a moment. One thing that's interesting to see is all of these sort of alternative numbers, block trades, EFPs, trade at settlement, and Clearport are spiking on the gold and silver markets. And I'll explain each one. Block trades is where you do a trade, you agree to it with a chosen partner, and then you report it all at once into the market. Clearport is a private trade that then gets reported into the market by private parties, sort of like a block trade. but it could be a collection of individual trades. You have EFPs, which is moving a trade from the Comex market in the US over to the UK market in that unallocated over-the-counter market. And then you have TAS, which is trade at settlement as order type that specifies the day settlement price as the order price. So basically what all these mean are people are trying to control the physical transaction instead of taking them to the market and trading at the market. Think about going to the stock market and saying, I want to put in a buy order for a stock at XX price. Can you fill? And you go against the stock market. Well, sometimes it's easier to do these one-to-one transactions where you go to a partner and say, let's do this transaction, let's agree to it, and let's put it on the exchange. And there are several ways to do that, from Clearport to block trades to TAS, and those are spiking up. And what it means is people are not going to the market to do the trades, they're doing them outside of the normal everyday market trade. And that's an indication, one, that there could be constrained physical supply for the physical side transactions, or two, that traders are wanting to agree outside the market because they see the big price swings. They want to ignore all that. They want to do independent agreements at certain prices that are advantageous to them outside of the big swings in the market. Why would that matter? Well, as we've seen the gold and silver market swing a little bit more violently in terms of price, that can wreak havoc with people's plans and trading on the market. So a lot of times they'll do these sort of private, independently settled transactions and bring them onto the market. So they're not having to trade the market itself. It just kind of, it's a hedge against market risk or trade risk that you have on a market when it's hundreds of thousands of contracts trading in real time. Right now for gold, August is a dominant contract, 343,000 contracts were open as of yesterday's close, as shown here on the chart. This is Monday's data. Again, high level of EFPs on Mondays. We go to Friday, still elevated level of exchange for physicals moving to the UK market is what that is. Thursday, again, high level. Although these have come down from what it was before, I suspect that's the summer trade. People are still requesting the middle, even though it is the summer trade. Settlements tab, the only reason I go to it is to show you that's where spot price is determined. For August, on Monday's data, it was down 70 cents. That's the change column. And August is a dominant contract here. You can see the higher numbers. So that's where the price is basically determined. Even though it could be blended with some other months, it usually is the dominant month which determines it. Up $3 on Friday, Tuesday up 23 bucks. So that basically just shows you where the prices are settled. Now, when I go to the COT report, I'll show you who's determining the prices by what they're trading. But I just wanted to show you the prices that you can see them all the time. If you want to know where spot's moving on an aggregate basis and how the trades are determining that, just come to the CME Group's website, look up gold, look up silver, and you can look at those charts. And I show it to you just to educate you on how this market works. Moving over to silver, we're now on the silver chart. As we can see, there was some elevated volume up through the end of June. But the last few days of June, July, it's calmed down. We have seen some deliveries on silver in July, which I'll get to here in a moment. In June, the deliveries were higher in gold, and we'll get to that in a moment. That's extremely important. But a lot of that happened before summer or at the beginning of summer. As you look at whatever the nearest closest big trading month is, people went for the gold and silver. I expect deliveries to kind of come down a little bit, probably till we get into September, October timeframe, and the rest of people get off of their summer vacations and off of the slow time in finance and kind of get back into the fall plans and making plans for investments for the rest of the year, tax planning, and seasonal investing for Thanksgiving and Christmas, which it does play a big part of it, especially in terms of retail and how we expect retail sales to do. We're going to see a lot of different trade there. And risk of the presidential election will play into that as well. But during the summer, we see this fade, and that's normal. In September is a dominant month in silver. You can see 129,000 contracts open of 5,000 ounce silver. You can see here that total volume of 45,989. That's about a third of the market traded in a day on Monday. That's pretty big. Lots of contracts going back and forth. It could be if you're a few pennies. It could be, you know, a lot of different things. But this is a heavily traded paper market with a very small percentage ever settled in silver, which I'll show you on the Nymex deliveries chart for gold and silver here in a moment. That's Monday's data. EFPs 360, not a lot. Trade at settlements 826, Clearport to private trades 360, no block trades. So in silver, a little bit less of these independently settled trades that are brought onto the market, like the block trades and the TASs, but they're still there. They're still elevated in terms of EFPs, even though the numbers are lower than gold. They're 5,000 ounce contracts versus 100 because silver is cheaper, and you still see elevated EFPs. So somebody's searching either for price differentials or for the physical in the UK market coming out of Comex, either because of liquidity challenges or because Comex usually underprices the metals because of the shorting that goes on, which I talk about every time I do one of these videos. That's Friday's data. As you look at Thursday's data, again, September, the dominant month there. 500 EFPs, 412 traded settlements, 500 clear ports. That's that. Going over settlements, just showing this tab again, Monday's data to show you where the price moved. This is the dominant month you see is in September, as I highlight this line in the estimated volume and prior day open interest numbers. You can see that September is the big contract month right now in silver, which is probably where we'll see the next month of heavy deliveries when we get outside of July. And that's where the trading's going on. It was up 53 cents on Monday. As we move back to Thursday, it was almost about even on the day. And as we move back to Wednesday, it was up 6.3 cents. Moving on to the commitment of traders, this is as of June 25th. It's always about a week in delay, get a week to 10 days in delay because they're collecting the information, putting this out separate from the closer to, it's not real time, but closer to real time or within 24-hour data that you get on Comex. This usually is within a week to 10 days as you get the aggregate positions. And here's silver, as I've got highlighted through June 25th. You can see that there's a heavy short position. Now, the weekly trade was down. As I showed you, the open interest was down 10,000 contracts in silver for the entire market. That means people were rolling contracts or closing contracts to the tune of 10,000, rolling to a future month or closing. That's normal in summer. You're going to see this roll off, this fade off in both gold and silver and some other the commodities markets as well. We pay attention to the swap dealers because they're the speculative group. The managed money is too. It's the financial houses, but the ones where you see a lot of the short interest come in and a lot of that price capping and maybe price suppression, if you want to call it, comes mostly from the swap dealers. We do look at producer merchants. They have a big short position, but it's legitimate hedging for what they're producing, the miners. And so it's legitimate. And the longs are legitimate hedging for the merchants, which are worried about upside price risk. What if silver goes from 29.5 to 32 and they're using it to make iPhones? They're going to take a long position as insurance. Most of the price insurance is going to come to the short side because it's the miners which have huge risk in getting the commodity out of the ground. If you think about it in the supply chain, getting the commodity out of the ground is the most important thing, because if you don't have it out of the ground, nobody can actually have it. So you see more shorting there on the producers, and they really have more risk because they put plans in place 5 to 10 years down the road to get this out of the ground. So they really need to hedge, the downside price risk. That's normal. But the swap dealers, it's mostly speculative. And you see right now that silver is almost 70,000 to 28,000. It's getting, not quite 2.5, about 2 1/3 shorts to longs. And that's been elevated. A few months ago, it was dead even at about 32, 33,000 contracts either side. And what this does, when you have a lot of this short position come in by the bullion banks, who can afford to do it because they do more trading than any other single entity, it tends to keep the price down. That's why the gold and silver prices have faded a little bit. And I think the swap dealers are loading up on short contracts because they know the summer fade's coming and they're going to make a little bit of money on it. I mean, that makes sense. It's not ideal for gold and silver physical investors, but just remember, if you're holding it long term. Don't worry about the seasonal changes too much. Just be aware of them and why they occur. And if you're looking to pick up metal cheap, spot prices are going to be down over the summer a little bit, which they typically are, unless we hit a black swan risk, a bank failure, or a new war, something along those lines. You expect that price to fade. It's a good time to load up. So if you're going to buy the gold and silver, that's my recommendation for people who have already decided that gold and silver is in their future. Again, we don't offer privatized trading advice. We just research and tell you what's going on in the markets. Consult your financial advisor before you do anything. But anyway, that's what's going on. Overall, the managed money is almost always long gold and silver. They're taking the long position because they see the financial risk. And in silver in particular, they see the requirements for silver to make the economy work, solar panels. Silver is used in everything. Most silver ever mined is used as an actual commodity, especially in the energy industries, tech industries, military, medicine, all of that kind of stuff. So they're long, and they've dropped some longs and shorts. Everybody does during the summer. Everybody's dropping a little bit. But overall, that's what's going on in silver. Gold, the same thing. Here's gold. As of June 25th, again, the positioning is you expect a heavy short by the producers. Makes sense. The swap dealers have really, really, really gone short here on gold, about 5 to 1. That's the biggest short, relative short positioning to long that I've seen from the swap dealers. Also the bullion banks, same name. But they did increase position on both sides, but mostly on the short by a factor of about 2 to a little bit more than 2 to 1. So they did take, probably this will be the last time that they really pile in on the short end unless they add some positioning over the summer. But I think they're positioned for the summer fade and they're going to make money on that. The managed money, of course, is long. They dropped some total contracts overall because why trade gold and silver in your portfolio if it's going to fade during the summer? So you see a little bit of that releasing of those positions by the managed money. These are the financial houses. investor services, ETFs, that type of thing. But they're still majorly long by almost a factor of 10 to 1. Actually, probably a little slightly more than 10 to 1 there. And overall, the other reportables, the wealthy family offices, things like that are long as well. So it's the bullion banks really putting all the short pressure on the market. That's no change from what it has been the last, I don't know, God, 15, 16 years since I've been following this. Nothing really new there, but when you see the prices come up, more than likely it's the swap dealers are going to be going long because you're going to have some risk in the market in which they're going to want to trade up. But almost always they trade down all the time, all the time, all the time. They're the big non-hedged short position or not fully hedged short position on the market. Always have been, probably will be for the foreseeable future until something fundamentally changes with that market. Okay, switching gears, we're now looking at the Nymex year-to-date delivery notices. These are physical deliveries, and by deliveries, I mean the warehouse receipt is changed from one entity, one owner to another. In the warehouse, it doesn't necessarily mean offloading or actually physically pulling it out of these depositories, but it does mean ownership is changed and somebody's buying it, and it means less is available for trading, even though it's sitting in the warehouse. If it's got a different name on it and they're not putting it into registered for trade, it's less available liquid gold and silver. So we look at Comex 1000 gold futures, and I told you last month would be a big delivery month. And in fact was, as you see highlighted down here at the bottom in this column, the June column highlighted down here, 30,728 contracts of 100-ounce gold were delivered in June. That's twice as much as we saw in December. December is usually the biggest delivery month, but we had double that, and we've had a lot of months, big months leading up to it. April at 18,166. February at 27.54. So people are taking a ton of gold off the market because of heightened financial risk. And they may be leaving it in the Comex for storage purposes, but it's being taken out of liquid inventory. I think that's mostly financial risk hedging in gold. And silver, it's a little different. It could actually be usage on the market in terms of as a commodity and some financial hedging, because that's what silver is. We're going to look at Comex 5000 silver futures as well on this Nymex report, as I've highlighted, but we're going to go down to the final column, which gives the totals. And as we look at June, we had 1,339 deliveries of silver. It wasn't the big delivery month like it was in gold, but July is. We've already got almost 5,000 contracts delivered. And again, that's more than December. So the big months in 2024 have all been bigger than the biggest typical month of December at the end of the year. December last year, 2023, had 51 contracts of silver delivered. In March of this year, you had 5487. In May, 6133. And now in July, 4922. Of course, about every other month is a big delivery month. In these markets is about 6 are big delivery months or big trading months. And you're basically all we're seeing is every single chance that investors have to go get delivery of physical gold and silver, they're taking it this year more than they typically would in a year. That's basically what that means. It just means people are going for the physical. And in silver, it's a combination of industrial use, commoditized use, and monetary use. A lot of this I don't think is by Americans, because Americans aren't buying gold and silver at their dealers a lot right now. They've been net sellers. We need terms of scrap and things that they're turning in and bullion that they're selling. I think most of this is going overseas. I think it's flowing west to east. Some of this could be going anywhere, but I suspect a lot of it's going into China, India, the Middle East, some into Africa, some into Europe as well. But it's certainly flowing out of most of the Western nations in that market. And I expect to see that going forward. It's been that way basically since 2011, net of everything. All right, now on to the World Gold Council report, which I teased at the beginning of this video. Here's the gold mid-year outlook 2024. They call it In Search of a Catalyst, and they're going to have a nice little analysis of the types of things that can affect gold price. I think it's wonderful, but overly complicated. And I'm going to simplify it down to you to a couple of really easy factors, but I want to show it to you because the information's out there. It's very heady if you're very into data and factors and heat charts and what could affect this and that and want to get into all the details. I'll give it to you, but then I'm going to summarize it in super easy terms, the stuff you really need to know. One of the charts I did want to show you from this report is year-to-date returns. Gold is second to stocks in terms of year-to-date returns. So don't let anybody tell you that gold doesn't return. It has returned. Even though it's faded here in the summer, it's still second to stocks in terms of return. And it's much safer than stocks in terms of it doesn't tend to lose its value over time and have big crashes like stocks do nearly as often. Over a 10-year period, it tends to be more stable and a portfolio stabilizer, so it's good to have. Emerging market stocks came in third after U.S. stocks and gold. And then you have other things like commodities, cash, so on and so forth. Global treasuries outside the US, ex-US, are down, not doing very good. US bonds are slightly down, almost even. Treasuries outside the US are absolutely crashing. Well, down about 6 to 7%, if that makes sense. Crashing compared with everything else. Market consensus suggests range-bound performance for gold in half two. The second half of the year, I think this is being a bit Pollyanna. I don't think it's going to be range-bound. They're saying that you have the 10-year bond is stable right now. Economic expansion is below trend, but improving, which I think is BS. I think we're in a recession, and the data reports that. So I don't agree with this from the World Gold Council. They say we have stubborn inflation, which actually is a boon for gold because gold does absorb the inflation cost and reflect it back. Geopolitical risk are a positive. Risk on positioning, basically this one right here in the middle, the pink, basically means investors are willing to take on more risk because they don't see the immediate crash, even though they're probably not looking at the economic data, because a lot of US investors, particularly in stocks, don't look at economic data until something actually happens. The bond investors do. But overall, here's this basically narrative that the gold market's going to be range bound for the rest of the year. I don't think it will be. I think after the summer, as the banking risk goes up, as the financial risk goes up, and the political risk goes up, gold's going to start to get more violent again. I think the summer is more of the eye of the hurricane in terms of 2024. If you remember what I said for 2024, it's going to be a little bit more violent in terms of price movements. We're going to have more stuff happen. It's going to be one of those hectic, sort of crazy up and down years, be leading up to what I think is going to be a big crash either later this year or starting next year. I think that in the economic day it's occurring now, but it won't be apparent in markets until later. So there's a lag effect between the economy actually goes down and when the markets start reflecting it, if that makes sense. So I think it's going to be worse than what they're saying here, but hey. One thing I wanted to show you was ETF holdings. This chart, the dark blue is Western Gold ETF holdings. Gold price tends to go up when ETF holdings go up. You can see that gold price has risen here. The price, the yellow line or the gold line has risen despite Western ETFs falling. Part of that is because later on they go on to talk about China ETFs. Here it is, China ETF going up. So China ETFs are driving the gold price up even when Western ETFs are fading a bit as we head into the summer. So who's holding up the gold price in the world? It's China, not the West. And that's why the gold price hasn't faded more from its high of like 2460, whatever it was, 2466 earlier this year. It's still in the mid 2300s because China's buying and those ETFs are keeping the price up despite the West fading. And I think China knows what's coming. And I think these ETF holdings are going to go up probably starting in the last quarter of this year and going into 2025 as uncertainty becomes more apparent. And that's going to drive the gold price up throughout the rest of the year. That's my prediction. All right, last little bit. I wanted to point out Kinesis, which is a channel sponsoring somebody that I use for gold and silver holdings. Also the ability to send it on the blockchain to somebody else very quickly, very cheaply. And with the debit cards in the US expected to be coming soon, hopefully in the third or fourth quarter, we'll have a fully functional gold-backed electronic currency. The great thing about it is it's audited. So Kinesis passed its latest audit. It's pretty much always passes its audit. It's done by Bureau Veritas, which is an internationally recognized auditor. They did the independent audit. Everything turned out great. This is a report you can see. They're going back to biannual audits. They've done quarterlies here for a year and a half, 2 years, just to prove out their system. Now they're going back to biannuals because they're passing them all. But this is the independent audit results. It's solid. People ask me about Kinesis and say, is it safe? I had a subscriber ask me this weekend, would you link your bank account to it? And I said, well, I can't tell you what to do, but I do, because essentially I think it's a stable way to hold gold and silver. You don't pay a storage fee there because they have fees through transactions that they use to pay for storage. And so you get a holder's credit. So if you have a gold and silver there, you're not paying them to secure it for you in an ultra safe facility that's audited and is awesome and safe. They're actually paying you because that puts gold in the ecosystem, which is then traded. And a lot of people are trading and making gold and silver actually money again by circulating it. Gold and silver can't be money if it's just held and never circulated. It just becomes basically rocks or metal that's sitting somewhere that does nothing. It does provide you some reassurance and peace of mind, but doesn't really do anything. But when you circulate it, that's when you get the benefits of gold and silver as money, as an inflation hedge, and removing inflation from the equation, because gold and silver, especially gold over long periods of time, absorb those inflation costs. And Kinesis is a wonderful way to get your gold and silver in motion. But even if you just want to store it somewhere, go to Kinesis, because you're not going to pay storage. They're going to pay you an amount that you get reported on every month. And if you're interested, of course, it does help the program. Full disclosure, I am a big fan of Kinesis. They are a channel sponsor, so I have an affiliate link. If you go down to the description, click on that affiliate link, fill out the KYC paperwork to open up an account. It does help the channel, and I appreciate that very much. This is the weekly market wrap-up for July 2nd, 2024. This has been Robert with the Freedom Report. Stay tuned this week, as I'm going to talk about the recent Supreme Court rulings and how that's could bring us back towards an originalist constitution interpretation and reduce the bloat of the overall federal government, as well as do some other things in terms of presidential immunity. I'm going to go over those in a separate short video that's going to be posted later this week. Stay tuned for that. So we're back to full content again. Thank you guys for supporting the channel. Until next time, this is Rob Kientz with the Freedom Report.